All attendees are in listen-only mode.
Good afternoon. Welcome to our webinar on planning for the inevitable, the exit from your business. My name is Amy Longmore, and I will be introducing your presenter today, Roy Johnson. Roy has over 40 years of experience encompassing corporate financial management, business consulting, entrepreneurship, education, investment banking, and mergers and acquisitions. Roy was the Director of Corporate Financial Planning for a Fortune 1000 company, a co-founder of 2 value-based strategy consulting firms, and a principal in management buyout, and the author of several articles and a book on shareholder value. Please type any questions you may have during the webinar in the chat box to the right-hand side of your screen, and we will address them at the end of the webinar. We hope you enjoy the webinar. Roy, are you ready to begin?
I am. Thank you, Amy. And welcome to today's webinar. And we're going to be talking about something that's going to happen to every business owner at some point in the time, because at some point all of us have to face the inevitable, and that is we will exit or liquidate our business in some fashion. It's going to happen. There's no doubt about it. It's just a question of when and how. And some of the questions we're raising on the first slide here is, is this going to be a voluntary or an involuntary type of event? Are you going to be well planned for it, or is this going to be more of an emergency? And you're going to be satisfied with the outcome or unpleasantly surprised. So these are some of the issues that owners need to deal with and consider, when they face an exit. Particularly if they're getting towards an age, and there's lots of baby boomers out there now who are obviously facing this perhaps sooner rather than later. And so some of the key factors, as we state at the bottom here, are when to exit or liquidate, to whom, how to do it, and for what type of consideration. So one of the questions a lot of you may be thinking about is why consider this, or why think about this now? There's an interesting piece of history that I thought I'd share with you to get started today. And during the past 35 years or so, there's been a very interesting 10-year cycle that's impacted business exits and sales. And it's been interesting that the beginning of the decades, 1980, 90, 2000, and 2010, during the first 2 to 3 years, we've experienced recessions and a phenomenon that we call deal recession, in which sellers have really suffered. The banks have kind of withdrawn, the investors have, kind of pulled off to the sidelines and shied away from providing capital. And then the middle years, the 3 through 8 years, and you can see, all these decades, and we're currently going through that now, have been pretty good for doing deals and transactions. Buyers have come back into the marketplace, capital's been available, and deal activity has been fairly robust. We have experienced this during 2013 to 15. 2016 is looking to be a pretty good year, and all the expectations, and I don't know how the election is going to affect this, but putting the election aside for the moment, the years through 2018 will hopefully, be pretty positive years also for transactions. What happens after that as we hit 2020, who knows? I recently listened to the author of this book from which this has been extracted, Rob Slee, give a presentation a week or so ago, and this guy has been fairly successful and has literally kind of lived his investment life according to this pattern. And for those of you who are interested in business books, Rob has written a new one. It's called Time Really Is Money. I've read it, and for those of you who like business type books, you might want to consider reading this one. Okay, so let's move on to talk about what's at stake. For many of you, it could be your largest asset, along with your primary source of income. and certainly pays for certain luxuries and some other kind of things, and certainly last but not least, for many of you, a source of personal pride and legacy. It could be a business that you either built or perhaps inherited and did something with, and most business owners that we come across, have quite a bit of pride and a sense of legacy in whatever business it is that they've created. So if this prescribes your situation, then I would encourage you to consider planning for this eventual exit or liquidation, and do that sooner rather than later. So you might ask why. And what we've tried to do here is to kind of depict graphically a fairly typical pattern that we find as M&A advisors and exit planners for what owners typically have on their balance sheets. Most owners have some, stocks and bonds and cash, and real estate is a big question mark. Some owners are landlords and own the property where the business is located, so they have another asset in there. Other owners simply, are tenants and rent their facility. So real estate is really a question mark, and that differs owner by owner. What we find is a fairly general rule, however, and there obviously are some exceptions, is that most of an owner's wealth is tied up in this illiquid asset that we call his or her business. And the business being private is illiquid. It's not like a public company stock that has a ready market at a price. And the reason that this exit planning is so important is that you're potentially talking about an awful lot of money here, and a situation where, due to the illiquidity, you're going to have one chance probably at liquefying this. And one of the things we come up with many of the owners is they tend not to view the business as an investment, but rather as a job or a career. That's not to say there's anything wrong with that necessarily. It's just something that you need to consider as an individual, whether you really look at this business as an investment for which you are expecting some type of a return at some point, or is it more of a job, place to go every day and do the kind of things that you like to do. So a lot of barriers out there with owners, especially with owners that have been in business a long time, particularly if there's a family legacy involved in this thing. Some of you are the business, so then the question is, who could possibly, take your place? And then what are you going to do after you leave? How are you going to fill your days? So what kind of outside activities might you have? A lot of you, I'm sure, have a very good status in the community. You might be wondering how that's going to change and how your family, friends are going to react, and those kind of things. And, we could go on and on about this thing, but I think suffice it to say that this gives kind of the essence of some of the key barriers that many owners face as they think about exiting or liquidating or transitioning their business. Now, for those of you who can overcome these barriers and kind of deal with this matter in a logical way, what I want to talk about next is a 5-step process to exit, liquidate, and I probably should add the term, or possibly transition, in some other way. So the first thing you want to do is establish your goals. These are very personal for you, and really get into what you want to achieve, either post-exit or post-retirement. Next thing is to determine your financial mental readiness. These are two distinct yet connected readiness profiles that you want to clarify and understand. Next thing you want to do is to identify the type of exiting owner that you most resemble. And then the fourth is to learn about your options, and then choose the one or two that are most suitable for you. Obviously, at the end of the day, you're going to have one, but there may be 2 or 3 out of the 5 that are available to you that should get consideration. And we're going to go through these in a few moments here. And then finally, understand the range of values that are associated with the option that you may choose. So what we're trying to do here is to give you a framework that'll enable you to execute your plan in a very logical, organized fashion, and hopefully achieve whatever goals you have, and also, very importantly, protect your wealth. And obviously, one of the things we always tell the owners, it's not necessarily what you get, it's what you keep, and that's something you certainly want to keep uppermost in your mind. Okay, so in terms of the first step, establishing your exit goal, these have a number of elements to it. There's a financial element, a personal element, professional, and then potentially some other ones. And you can see these on the screen here. From a financial perspective, one of the key factors are your disposable income needs. What do you want to have to live on post-retirement or post-exit? From a personal perspective, you get into lifestyle issues, family, and things of that nature. On a professional level, you may have some family or colleagues who are in the business. You're going to want to consider their role. And then certainly, what kind of replacements are there for you? And then hopefully, at least not for a while, you're not going to have any health issues, but they certainly do, in some instances, play a part. So the key here is to try to get clarity on what it is you really most desire for this future. In terms of determining your readiness, the way we approach this is to look at a 4-quadrant matrix that has 2 key elements, financial and mental readiness. So you'll see that we're kind of plotting financial readiness along a vertical axis and mental readiness along a horizontal axis. And you can see how this is positioned here, where if you have a high degree of mental readiness, you're really ready to get out of the business, you would be profiled along the right-hand side of this horizontal axis here. And if you had a high financial readiness, you'd be in that upper portion of the vertical axis here. And then you can see how this thing kind of works in terms of the rest of the positioning. So there's a very simple test or a survey that we give. It's complimentary. It's called the Business Exit Readiness Index, BERI, B-E-R-I, the BERI Index. It's a 20-question survey that you can take through us, and we'd be happy to offer this to you at no charge if you feel this would be useful to you to kind of get started on an exit plan. And the BERI report will help you determine kind of where you are. So some of the questions that are asked, in this index that basically you do a self-determination on are: how involved are you in the day-to-day operations? And again, do you view the business as an investment or a job? We've covered some of these issues previously. So this is the first element of this second step here, exploring mental readiness. So this is an exploration. This is where you kind of get inside yourself and really think about how mentally ready you are to leave the business. The next thing, which is a more analytic type exercise, is to get into your financial readiness. And some of the key questions here are: will you be able to live the way you want to outside of the business? Do you have any other sources of income? How are you going to pay for some of these perks and bennies that now may be running through the business, and so on and so forth? And then finally, as I said before, it's not what you get, it's what you keep. How much is the government going to take, and then what's going to be left over at the end of the day for you? So when we're analyzing financial readiness, the key thing we do here is to establish what we call a value gap. And the way we do that is to look at the liquid and other assets that you have, those that can produce income, and then look at the kind of income that you're looking at post-retirement or post-exit, and then compare what you have with what's going to be required to do that. So if you've got a $300,000 income, let's say, now, and you're not going to be working in the company after you exit, obviously you're going to need a fair amount of asset value to produce that $300,000, if that's the number that you may want to live on down the road. So the value gap analysis is a very key element of determining financial readiness. The next thing, third step here, is to identify yourself. You know, which type of exit owner, what type of exiting owner are you? So if you are a person that has a very high level of mental readiness and you don't have a lot of money, you know, you really don't have assets outside of the business to support the way you want to live post-exit, you would be positioned in this lower right quadrant here, and you're the type of owner who wants to get out, and you probably want to get out at the highest price. On the other hand, if you may have a lot of money outside the business, have some other assets that can produce income, but you still want to get out, we would call you rich or wealthy, but you're still ready to get out. So you probably are going to want to pull the trigger here at some point in the near future and do some type of a transaction. On the other hand, if you really like what you're doing, if you're under no pressure or have no desire to get out, and if you don't have a lot of assets outside the business, we would say that you're in a stay and grow situation here. You need to build some wealth so that ultimately you would have enough to retire comfortably. And believe it or not, most business owners find themselves in this quadrant of the matrix. And then finally, we have the business owner who is very well off, but he just likes to work. You know, he likes his company, he likes his business, doesn't really have any strong desires to sell it or liquidate it in some other fashion in the near future. And even though he could retire, he chooses not to. So these are the four major types of exiting owners. So what the Berry report will help you do is to determine which one of these quadrants you fall in, and it'll be through this 20-question self-evaluation. The next thing is to learn and study about your exit options. And you've got 5 that are out there. First one is the employee stock ownership plan, an ESOP. Secondly is a management buyout. Third, you have a gifting program or some type of family transfer. And then fourth is a private equity group recapitalization. You know, a lot of people call us a PEG recap. I think all you know what private equity groups are. And then finally would be an outright sale of the business to a third party. So the first 3 of these are what we call internal transfers. You know, somebody inside the company is going to take over, either get the stock or the assets or what have you. And the last 2 are external transfers. You know, an outside group is either going to come in and buy out the company entirely or at least a majority of it. And there are certainly advantages and disadvantages to each, as I'm sure you would expect. And this is no different from everything else in businesses. And there are obviously trade-offs, you know, that need to be evaluated. Just very quickly, in terms of looking at the ESOP, one of the advantages is that it provides the owners with a ready market at a fair market price. And it provides the buyer, provides a buyer, I should say, who's willing to take the seller's common stock. That is not the case with most transactions. Most buyers, for a lot of different reasons, which I don't have time to go into today, want to buy the assets. It's less risky, there's certain tax advantages, and so on and so forth. It's exactly the opposite for a seller. So a seller typically wants to sell stock, a buyer wants to buy assets. What the ESOP does is provide a buyer who's more than willing to take the stock. Big disadvantage with an ESOP is that the seller is going to have to finance at least a portion of the transaction price. With a management buyout, you know, one of the advantages is that the owner can often stay. He's going to sell to, you know, his key people in the business, and he may have a role. Could continue on as the CEO or maybe take another role. Big disadvantage with a management buyout is that there are no competing bids, so you're unlikely to get the highest price. Next is a gifting program where the family business, you know, legacy continues. That's an advantage, and this can often be a very effective tool for estate planning. Biggest disadvantage here is that there's no liquidity for the owner, and then you also have the risk that if something happens with those you transfer it to, you know, could be a rather unfortunate situation. So those are the three internal ones. On an external side, a private equity group recap. And I will say here, you have to have a business that's really large enough to be considered by a private equity group. Probably a business that has an absolute minimum of $5 million, but more like $10 million of revenue. They want to see EBITDA in the at least $1 million range, more preferably $2 million. So if you're a business with a $10 million revenue and $2 million or so EBITDA, then you would be considered for a PEG recap. Below that, it's going to be difficult. Big advantage here is that you have liquidity options. Most of these PEGs want control, so they're going to want at least 51%. But a lot of them will be flexible between that amount and say up to 80, maybe some cases 90%. So you do have liquidity options. And if you do stay on, you know, as a partial owner, you have a chance of what we call a second bite at the apple. And if the private equity group is successful, that second bite can often be worth quite a bit, because obviously, you know, their objective is to grow the business and make it more valuable. Big disadvantage here is you get a boss. And you know, that may or may not be a huge disadvantage because most of the private equity groups don't want to come in and run the business. They just want to make sure that you're performing. Okay, and that leads us to the sale of the business. A big advantage here is going to give you the highest price, so it's your best liquidity option. Major disadvantage is that it can be long and expensive. Business sale can take anywhere from 8 to 12 months, and you've got, you know, fees that are going to be associated with that. So that's just a little bit of a kind of an overview recap of your options. So now if we look at the options, we want to see how they fit into the exit quadrant chart. So the low financial readiness, you know, high mental readiness is going to be an outright sale. Mostly that's about the only option you have. If you're in that upper right quadrant here, you have the options of gifting the business, doing an ESOP, or selling it. If you're in the lower left and you're big enough, you could do a PEG recap. You could certainly do an ESOP regardless of your size, and then certainly just kind of stay on, grow the business, and build up your wealth position. If you're in that upper left quadrant, your three major options are going to be a management buyout, some type of a gifting program, or an employee stock ownership plan, an ESOP. So this is kind of how the different options fit into the exit quadrant chart. So the last thing we want to talk about are the types of values that you should expect in terms of these different exit options. So if we're looking at an internal transfer, a gifting program, an MBO, at an ESOP, you are going to be looking at fair market. You're going to be looking at a financial value. They're going to take the books and records of the company, look at the profitability, establish, you know, some kind of a multiple of EBITDA or some other type of valuation. And these are going to be done on what is known as fair market value standards. Now, A fair market value standard is pretty much outlined by the IRS. There's a portion of the code that outlines, how you do it, what you need to do. You are required to do this for a gifting program or an ESOP. That's the law. You are practically going to do this for a management buyout because in all likelihood the managers won't have enough money to pay you beyond what's known as fair market value. And I'll just mention this very briefly when we get into certain types of gifting programs, or sometimes in the management buyout you can have discounts for minority holdings, in terms of lack of marketability and those kind of things. So the internal transfers are going to be governed either legally or practically by what's known as fair market value. When we get into the external transfers, the recaps or the sale of the business, here we get into what's known as market value. And this is typically beyond what's associated with the books and records of the company. If you kind of look at the public market, you see market values are all over the place, and it really deals with the expectations of the buyer. And you've got two major elements here. One is the investment value that you get in a PEG recap. And finally, when we sell businesses and do these outright transactions, usually for 100% of either the assets or the stock, we're always trying to find what we call a synergistic or a strategic buyer, and they will usually pay the highest price. So the business sale will get you into the whole area of synergistic and strategic value beyond what's associated just with the financial performance of the company, because that buyer will see something that's out there that's not necessarily reflected in the in the financial performance. So that's just a quick overview of the range of values. One of the key things that all of you should be thinking about is what we call creating a transferable business. And this means that the business has grown less dependent on you, the owner, for its effective and efficient operation. And this means having a business that has people that another owner wants to keep, or that you're confident in turning over. So there's a lot of elements here. Again, there's another measurement test. It's called the Owner Dependency Index. It's something that we make available to those who engage us in an exit planning engagement. This one we don't give away, but it's a very, very dynamic tool and really sets the stage for what owners need to consider in terms of exiting or selling a business. So finally, to conclusion, there's two ways to execute an exit plan. And what we offer here at Touchstone is what we call a summary plan. This is a software-driven approach for those who are kind of sticking their toe in the water and thinking about developing an exit for the business. And then there's the full plan for those who have made that commitment. They know they need to exit. They know they need to plan for it. And they want a truly in-depth analysis about all these options, and then along with a path forward to, achieve what it is that they want to do, post-exit or post-retirement. So finally, in terms of our role as your exit plan advisor, we're kind of like the point guard on a basketball team. We're distributing the ball to a lot of different people. One could be to an M&A advisor, and obviously in this case, if the business is for sale, we would probably hand it off to ourselves because we do these types of transaction as a major part of our business. Second major player would be your financial or insurance advisor. This is if estate planning or wealth protection is critical. Your CPA is going to be involved along with your attorney. And those are the key players that are on the team here. So what we do is try to coordinate all the activities and get these people engaged at the appropriate time and when it's necessary for them. Just to conclude with a little bit about us, we are an exit planning and M&A firm, and you can see kind of how we specialize. To do exit planning, we're looking for owners with companies that have revenues of $5 million or more. We're looking to sell businesses that have at least a $2 million valuation, you know, up to perhaps 20+ million. And we'll also do, excuse me, some acquisition work for owners who may be looking to grow by acquisition. That's kind of a separate element of our business. And in terms of industries, it's mostly manufacturing, distribution, technology, and B2B services. So I'll turn it back over to Amy now, who will tell you about our next session.
Thank you, Roy. I would like to take a moment to let everyone know that our next webinar is scheduled for December 8th at noon. Our topic, 9 ways to leave your business. You may register at our website, www.touchtoneadvisors.com, or watch for an email invitation. We hope you will join us again. This concludes our session for today, and thank you.